On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. New Zealand's long-awaited economic recovery has been delayed, but it hasn't been cancelled. A more prosperous period is likely ahead, but we do need to exercise some patience. The Reserve Bank not only cut the official cash rate, the OCR, last month, but it slashed its forecast for where the OCR goes from here. At 3%, right now it's well down from the 15-year peak of 5.5% that prevailed just over a year ago. Two further 0.25% rate cuts are expected. That would take it to an expected trough of 2.5%. Now that would be the lowest that we've seen since the middle of 2022, although it would still be higher than it was in the 4 years leading up to the pandemic. Remember that the OCR was just 1% in the latter months of 2019, and that was before anyone had even heard of COVID-19. At that time, the unemployment rate was sitting at 4.2%, which is much lower than today's 5.2%. That makes you wonder what's stopping the Reserve Bank from being even more aggressive. However, the big difference is inflation. Back in 2019, headline inflation had been consistently below 2% for several years, and the more troublesome non-tradables inflation, which is domestic inflation, was comfortably below 3%. Today, you've got headline inflation running at 2.7%, and domestic inflation is higher again at 3.7%. Now, that headline inflation rate of 2.7% is still well within the Reserve Bank's target band, but it's closer to the top than the bottom. Even so, an OCR of 2.5% will still make a big difference, especially when you consider that the rate cuts until this point haven't fully worked their way through the economy. Mortgage rates are now below 5%, although borrowers are still paying some 0.5% above that on average. Most of us fix our mortgages, so when the OCR falls or banks reduce mortgage rates, we don't benefit from those lower costs right away. So even though people have flocked to the shorter term rates in recent years, the 6-month rate, the 12-month rate, it will still take some time for them to roll off those higher rates and onto the new, lower ones. I'll give you an example. I refixed a mortgage in December last year at a rate of 5.59% for 12 months. That was a pretty good rate at the time, and it was certainly a big fall from the 6.99% I was paying 12 months before that. When renewal time rolls around in December this year, the prevailing 1-year rate could easily be a full 1% lower again. And for a typical borrower with a mortgage of $600,000, the difference could be a monthly saving of $351 relative to current outgoings. Now you extrapolate that across the whole economy and you can see how the pressure on household budgets will continue to ease. The steady stream of mortgages moving on to lower rates will hopefully boost activity and spending, putting businesses in a stronger position and giving them the confidence to grow, hire, and invest. We need to keep an eye on things like card spending, freight and traffic indicators in the months ahead, as well as business and consumer sentiment. Those are all the places where signs of a rebound should show up first. It will take some time, but 2026 should be a much better year than the last 3 have been. If cutting the OCR to 2.5% is indeed the shot in the arm that our economy needs, we could be facing another Reserve Bank tightening cycle sooner than we think too. A few economists have been very quick to point this out, and it's a valid point that we need to keep in mind. However, first things first, let's focus on the recovery for now and worry about rising interest rates later. Besides, I think we'd all be pretty happy to be talking about OCR hikes this time next year, because that would mean that growth has returned and that the economy and labour market have improved. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.